Hi, my name is Lisa Richter. I'm the Director of Industry Outreach and Growth for CSIA. Welcome to the Masterclass. Before we get started, a quick word about CSIA. Maybe you've heard of us before this today, but if you have not, all you really need to know is that CSIA's mission is to help system integrators build better businesses. How do we do that? Well, for starters, we have a team of volunteer SIs who have crowdsourced a best practices manual to help system integrators scale their businesses. In fact, the BP committee regularly reviews and updates the manual. It is currently on its 6th edition, and the committee is already planning the next version. For those companies that want to take these best practices to the next level, CSA also offers a certification program that includes a third-party audit. Many companies find that this audit is extremely helpful for helping them understand their business and how to scale. CSIA is also helping system integrators grow their businesses with a new Learning Hub, which is an online platform with content and playlists. Yeah, that's the next slide. That have been sourced and vetted by seasoned SIs to help members get their teams up to speed quickly. Think of it like Spotify. All the content is there, but imagine having a personal DJ who spent over 20 years getting to know your preferences and tailoring the perfect playlist just for you. CSA also offers access to vetted professional service companies, including financial, insurance, and legal, who understand the SI's unique needs. Something you will see for yourself today, as today's speakers are with WIPFLI, which is CSIA's partner for business and tech advisory services. With thousands of qualified integrators and suppliers, the CSIA Industrial Automation Exchange helps SIs, industry suppliers, and manufacturers connect and do business. For SIs and partners, it provides a platform to support your content and SEO marketing efforts, position yourself as a thought leader, and nurture prospects during their complicated buyer's journey. If you are not currently a member, now is a great time to join. Membership provides you and your entire team a full lineup of virtual events and other resources, from accounting to sales to operations to training, 365 days per year. It also means you and your team can attend the CSIA conference, because this annual in-person event is members only. If you are currently a member, thank you. If you want to just get a flavor of CSIA and its members, I would encourage you to listen to the Talking Industrial Automation podcast. CSIA members talk all things industrial automation, and it's just a great way to hear what your peers are up to. One last housekeeping note before I turn it over to today's speakers. If you have any questions during the presentation, please use the Q&A feature in Zoom. That helps us stay organized. The session is being recorded, and you will get a link to the recording in the next day or so. At this time, I'm going to turn it over to today's speakers, Tim and Sarah. Take it away. Tim, you're on mute.
Oh, thanks, Lisa. I got the sharing the screen. So today we're going to talk about, I guess before we get started, we're going to talk about the One Big Beautiful Bill tax update. Both Sarah and I have been involved in CSIA for 7+ years. I'm a partner at WIPFLI, as well as Sarah is. We both focus on the system integrator industry. Some of the things WIPFLI does with the industrial automation service lines is our core services, which is tax compliance and planning. A lot of it has to do with R&D tax credits and kind of looking at plant and equipment incentives, which we'll talk about today as well. We have our typical audit and audit and accounting services, as well as working on a lot of M&A transactions, helping with QOVs for our clients, and even doing some investment banking services for some of our clients. Our advisory services, we've been helping clients with software selection and coaching, both on ERP and CRM services. We're Microsoft Business Central partners, as well as NetSuite partners. We do Microsoft Dynamics and Salesforce CRM implementations. and then have an operational performance group that looks at benchmarking, sales process, as well as our outsourced CFO services, CAS services, cybersecurity, and data and analytics services. So before we get started, kind of the agenda that we have is we're going to give a little overview of the OBB overview, some business provisions that we'll talk about, some individual provisions. I know that in the CSI community, we have a lot of international companies as well. So we'll talk a little bit about the international things that are out there, which there was quite a few changes. And then, we said other, which would be any questions that you have or just some other general things that are going on with the bill. So I'd like to turn it over to Sarah to get this started.
Thanks, Tim. As Tim said, we're going to go talk a little bit about an overview of what's in the One Big Beautiful Bill, affectionately known in practice as OBBB or OBBB. On July 4th, President Trump signed the bill into law after it narrowly passed the Senate and the House. Prior to this legislation, many of the provisions that were enacted in the Tax Cuts and Jobs Act of 2017 were set to expire. So good news for most businesses as most of those provisions have been made permanent. Some of them have been changed slightly or modified a little bit, and some are going to remain unchanged. So we'll talk a little bit more about that. One of the biggest things out there is the SALT deduction. So the Tax Cuts and Jobs Act limited the state and local tax deduction that you receive to $10,000. This has been a point of contention within the House and the Senate as senators and representatives and high tax states have been getting a lot of pushback from their constituents. They tried to completely eliminate the SALT deduction, but they were unsuccessful as the bill costs a fair amount of money, and so they needed to limit the cost. What they did is increase the deduction to $40,000. However, there's a threshold. If your modified adjusted gross income is above $500,000, you're going to start to get phased out of that $40,000 deduction. And this is not a permanent deduction. It reverts back to $10,000 in 2030. So a lot of states have enacted what they call a pass-through entity tax, which it allows, if you're in an S corp or a partnership, it allows you to take the deduction at the entity level rather than taking the deduction at the individual level, sort of circumventing the SALT deduction cap. So to the extent that you've made those elections, I would say those should remain unchanged and you should continue on with those deductions. I mentioned that Tax Cuts and Jobs Act, there were some cliffs that were coming. A lot of provisions were set to expire at the end of this year. Most of those were made permanent, and we'll get into more detail about the R&D provisions that are included in the bill because there's some pretty specific things that you'll want to think about as it relates to that.
Sarah, one quick thing on the SALT deduction. One of the things that we've been looking at with some of our system integrators that might have multiple owners is that the $40,000 may be enough for them. So the PTE election that they did make may not be applicable anymore, meaning it's just, one less thing that might have to do. So again, I think it's a little bit of, as we're looking at those things, talking with your advisor of what the best way of doing it.
Potentially. I do want to point out that the PTET election is an entity level election. It's not an individual election. So you wouldn't want to look at just one partner to see if it makes sense. You have to look at the group as a whole. But certainly those are things you want to think about as you're going through and making any election in the tax world. So a couple of Trump campaign promises he made, I think everybody remembers him on the campaign trail out there saying he's getting no tax on tips, no tax on overtime, no tax on auto loans, factory write-offs. Some of these campaign promises he was able to actually deliver on. whether or not to the degree he wanted to, probably not, but he was able to get some of these things through. The biggest ones are for more lower income tax folks, so potentially your children. If you have kids that are in the job force or working in restaurants, there's no tax on tips up to a certain amount. So there's income thresholds for everything, but the first $10,000 of tips, if you're under, I think it's $100,000, are going to be tax exempt. Similarly, OT, overtime is, you get a deduction for overtime up to $25,000, married filing jointly, or $12,500 if you're a single filer. These are items that will have to be reported on a W-2. So to the extent you're paying overtime, make sure you're working with your payroll tax providers to ensure that you're properly reporting this information on your employees' W-2s. No tax on auto loans. We'll talk a little bit about that later, and we'll also get into factory write-off. What's this new term called qualified production property? Because there were a lot of things in the bill that are going to cost money, there are some revenue offsets we'll talk a little bit about. He's rolling back the energy credits that came out in the Biden bill, which was deemed the IRA bill. Those are going to be ending sooner than planned or completely rolled back. I'm not going to get too much into charitable and college endowment changes. The remittance tax, which really didn't come to fruition as heavily as he wanted to. And then, his big thing is to eliminate waste and fraud. So these are all provisions that are included in the bill. We're going to mostly focus on the tax issues and not get into some of the things that may not be applicable to this audience.
Sure, before I move on the OT overtime, it's just the portion, the half time, right? It's not the full overtime portion. Meaning, like, if you're time and a half, you're just getting the half time. That's
Correct.
so.
Correct.
And just for the audience out there too, there's a Q&A section if anybody wants to ask questions in there. And also, the slides will become available after the end of this webinar as well.
So what does this all mean for the automation industry? I think the biggest provision that's in here that's going to impact this industry is the Section 174 provisions. So I'm sure most of you on this call are aware that Tax Cuts and Jobs Act required Section 174 expenses to be capitalized and amortized. The amortization period was 5 years for domestic research and 15 years for research performed overseas. This created a fairly large cash strain as a lot of automation companies incur a fair amount of Section 174 expenses, and not being able to deduct these on your tax return, it resulted in increased taxable income. So the One Big Beautiful Bill allows you to expense R&D expenses beginning in 2025, immediate expensing going back to the pre-capitalization days. Foreign research expenditures, however, are still going to be subject to that 15-year capitalization and amortization policy. So if you have research being done overseas, you are still going to be required to capitalize and amortize those expenses. For small business taxpayers, you can elect to amend 2024 through 2022 returns for retroactive treatment. Small business taxpayers are those which are under $31 million in gross revenue. All taxpayers will be permitted to change their accounting method in 2025 and make an election to deduct any remaining unamortized amounts, either over 1 year or 2 years. So you may take a look at this, especially if you're a small business taxpayer, and think, this should be a no-brainer. I'm going to amend my returns from 2022 through 2024. I would put some caution to that, mostly because the IRS is taking a fair amount of time to process amended returns. Anywhere I've seen 6 months to 18 months to even longer in some instances. So depending on your taxable situation, it may make more sense to just take the unamortized deductions in 2025 and 2026. You sort of need to model that out, because you're going to recognize that cash flow impact immediately via the reduced quarterly estimated tax payment requirements. Most of my taxpayers who are in a small business, are meeting that small business threshold, are basically not going to have to pay an estimated tax payment for Q3 because they're going to have a significant deduction coming through from this unamortized Section 174 amount. Your other question that's out there is, hey, I haven't filed my 2024 return yet. Can I just take the deduction in 2024 and not have to amend it, not file it as if I have to capitalize and then amend the return at a later date, maybe the very next day? I think that I know that the legislation doesn't actually provide for that to be allowed. We are still waiting on some guidance, and we are expecting some guidance to come out. Whether or not it will come out before September 15th, which is the due date for S corps and partnership returns on extension, is yet to be seen. But I think one piece that's in the legislation is that this is an election. And so if you were to if file your return and take the deduction in 2024, even though the legislation is clear that it's allowed on an amended return, I have heard practitioners out there saying, well, we can just take the deduction this year because if we were to be audited, it's allowed in the legislation, so the tax impact would not have changed. But because this is an election, I think that unless we get guidance otherwise, that you're locking yourself into the election to amend your returns, meaning you can't take the deduction in 2024 and then deduct whatever unamortized amounts you have left in 2025 and 26. I think if you did that, you would be sort of pushing yourself into a situation where you're electing to amend, meaning you're going back and amending 2022 and 2023. So I'd be a little bit hesitant taking the deduction in 2024 on an originally filed return, especially without any guidance out there, because we don't know yet what guidance they're going to come out with on how to amend your returns and what statements or elections you're going to have to put into place on those amended returns. And until we get that guidance, it's a little bit foggy, if you will. So those are some things to think about when you're going through the decision on what you want to do when it comes to your R&D expenses. Tim, do we have any questions here yet?
We do not have any questions on that one, but there is a question related to the PTE election. And really, the question is just, what is the PTE election? What does that mean?
Okay, so certain states, and I forget the number, I think it's 32, don't quote me on that, roughly 32 states have come out with what's considered a workaround from this SALT cap, the SALT deduction cap, and that they have instituted legislation that says you can pay your state income tax on your business tax return. So typically, S corporations and partnerships, the state tax is actually paid at the individual level because income flows through to the individual. And many states have come out with a workaround to allow you to pay that tax at the entity level. And what that results in is lowering your business income that flows through to you personally. So basically, you're getting the deduction via a lower taxable income that's flowing through from your business. So if your state has one of these workarounds, it's something that you should be looking into to determine whether or not it's beneficial. If you've had losses over the years, it wouldn't make sense to enter into one of these elections because you wouldn't really be getting the benefit of it. So certainly some analysis that needs to take place to determine whether or not it makes sense for you to make an election where possible, but certainly worth looking into if you haven't already done so. And if you if you want to reach out to me and talk a little bit more about that, I'm more than happy to do so. We have a fair amount of experience with these elections. So other great things for businesses that should impact the automation industry and your clients. So this is one of the things that I think allows maybe your customers to invest in capital expenditures because they're getting immediate write-offs. So bonus depreciation has existed since the Bush cuts of, I think, 2002. President Bush came out with some tax cuts, and one of those big things was bonus depreciation. It allowed for immediate expensing of capital equipment. The Tax Cuts and Jobs Act was phasing bonus depreciation out. In 2025, bonus depreciation had gone down to 40%. But this act restores bonus depreciation for assets acquired and placed in service after January 19th, 2025 to 100%. So to the extent you're putting capital expenditures in place after President Trump was inaugurated, you get a full 100% depreciation deduction in the year the asset was placed in service. January 1st, items put in service January 1st to January 19th are only at 40%. There is some specific rules surrounding that, written binding contract rules. You need to get into the details a little bit outside the scope of this presentation, but just know that 100% bonus depreciation is back and thriving. In addition, Section 179, which there's two, bonus depreciation allows for 100% deduction, as does Section 179. The difference is bonus depreciation could create a loss, whereas Section 179 is limited to income. So you could have bonus depreciation and create a loss for yourself, whereas Section 179 would not. That additional deduction would carry over. But to the extent you have income, you could have taken Section 179, which allows you to deduct 100% of fixed assets placed in service as long as you haven't invested in more than $4 million. The 179 deduction is increased to $2.5 million and applies to property placed in service after December 31st, 2024. So all of 2025 gets the higher benefit. So you may be in a situation where you put some assets in service between January 1st and January 19th. Maybe you'll take Section 179 deduction on those assets, and for the other assets placed in service after January 19th, you'll take bonus. Both of the amounts, the Section 179 amounts, the phase-out amount as well as the deduction, are indexed for inflation annually, so those amounts will increase over time.
In bonus there's no phase out amount, correct?
There is no phase out for bonus. That's correct.
And sometimes under 179, different asset classes qualify for 179 than bonus. Something like a roof would qualify underneath 179, where it's not going to qualify for bonus, correct? Meaning like other assets that you may be looking at. So
there's certain assets qualify for Section 179 that may not qualify for bonus, although that's not quite as common anymore with the qualified leasehold improvements, Tim, the 15-year life assets. So there's a new provision in the bill called qualified production property. And this allows for, it's a new incentive for the construction of manufacturing or production facilities. There is no guidance on this yet, so I think there's still a lot of questions as to what will qualify. However, the result is basically allowing a deduction equal to the basis of the qualified production property of 100%. It's like bonus depreciation on the construction of a manufacturing facility. We do know that qualified production property, if you're building a new facility, will only be the part of the facility that is going to be used for manufacturing or production. So if you have a facility that has 100,000 square feet and 15,000 square feet of that is office space, the office space will not be qualified production property, but the rest potentially would be. This is only applicable for qualified production property after July 4th, 2025. So if you were in the process of building a building prior to 2025, this wouldn't be qualified. It's really meant to incentivize new qualified production property after the passage of this legislation. So a lot of times right now, if you buy a new building, and it also has to be a new building, so you can't be buying a building and then retrofitting it for qualified production. It's really construction of a new building. Oftentimes what we do for companies that are purchasing or building a new building is we'll do what's called a cost segregation study. And that has been meant to segregate assets from 39-year life property. So real estate is required to be depreciated over 39 years. But a cost segregation study allows you to break out components of real estate that may go into a shorter year life, which you're looking for is 15 years or shorter, so that it is eligible for bonus depreciation. I think if you're building a new building, you would still want to do a cost segregation study to make sure you're maximizing the manufacturing and production areas and ensuring that you sort of have the documentation that would be required upon audit to demonstrate what is considered qualified production and how you came to the conclusion that you were eligible for that 100% deduction.
I think the cost segregation study also on the office space and other things can cause lesser lives on some of that stuff as well. So that's where there's additional benefit as
sure.
well. There is a question, and I know that there isn't guidance on this, so we may not be able to answer yet. But what if my real estate is in a related entity, but not the entity doing the manufacturing? Am I going to be able to qualify?
I think so, because there is not guidance on this yet, but I think so, because there are rules in the tax code already that exist that allow you to group real estate activity with the operating business activity. So for tax purposes, they're sort of deemed as one activity. Otherwise, your real estate activity could end up being passive activity, which would be subject to rules you may not want to be you may not want to be subject to. So I imagine the grouping rule will come out for this, because oftentimes the real estate is in a separate entity. And if we know anything about Trump, he takes full advantage of the real estate tax rules. So I can't imagine a world in which these grouping elections wouldn't be available in this regard.
Okay, great. I know that we got a few more slides here. Is there more that you want to talk on this, or
I don't think so. I think we've probably covered enough of this. Interest expense limitation. So for businesses that are greater than $31 million in gross receipts, their Tax Cuts and Jobs Act created what is called Section 163J interest expense limitation. And it came up with this concept that was adjusted taxable income, and basically limited the interest expense deduction you would receive to 30% of adjusted taxable income. The adjusted taxable income calculation has changed since the Tax Cuts and Jobs Act, as it phased in a lower income calculation by not originally you were allowed to add back depreciation and amortization, but as the rules stood before this new bill, you could no longer add back depreciation and amortization. So basically it had the effect of lowering the interest expense that you were allowed to deduct. OBB increases the maximum amount of the deductible interest expense by changing the definition and basically allowing depreciation and amortization to be added back to this adjusted taxable income calculation again. The one place that I think that there is some question on, that hopefully we'll get guidance on before 2026 filing season, so filing for the 2025 year, is whether or not the Section 174 deduction that you may take in 2025 for the unamortized amount is going to be considered amortization expense. Obviously, if not, it will have the impact of probably limiting your interest deduction. The good news is the interest deduction carries forward to future years. So it's not as if you lose the interest deduction, it just, you don't get the benefit of it in the current year. But there is some question as to whether or not this Section 174 deduction in 2025 is going to be considered amortization. It may be considered just a deduction. That's how the legislation was written. But oftentimes the IRS will come out, Treasury will come out with guidance and regulations that sort of extrapolate upon what Congress's intent was for the rule. So we'll see, TBD on that. Qualified small business stock is an incentive that has existed for many, many years. I'm not going to get into detail because this webinar doesn't have time to get into detail on what is qualified small business stock, but just know that this is only C Corp stock. So if you have an S Corp, this is not applicable to you, but the tax legislation increased the minimum gain exclusion that is allowed on qualified small business stock when you sell your stock. So the old rules allowed for up to a $10 million gain exclusion or 10 times your basis in stock. The new rules increase that to $15 million, and it's a per shareholder gain exclusion. The old rules required a 5-year holding period. The new rules allow for a phase-in, whereas if you hold it for 3 years, you get 50% of the gain exclusion, 4 years, 75%, and after 5 years, you get that 100% gain exclusion. So this is a big benefit for C Corps, but you must be qualified as a small business stock, and there's a lot of rules around that. Again, if this is something that you want more information on, feel free to reach out to me. I have a fair amount of experience in this area, and I'm happy to have a conversation with you. Other rules out there impacting S Corps and partnerships. So the new law extended and made permanent the tax rates that were enacted with the Tax Cuts and Jobs Act. Without this legislation, the highest individual tax rate would have reverted back to 39.6%. So the 37% remains permanent for now until, Congress does something else. Who knows? It also makes permanent the increased standard deduction, which has the impact of less folks itemizing their deductions because the standard deduction is now so high. It permanently repeals the personal exemption, and it increases the AMT exemption amounts and resets phase out amounts, indexing them for inflation. This is important for R&D purposes, especially for businesses that are above that small business threshold of $50 million in revenue. It makes permanent, this is great news for all S Corps and partnerships. It makes permanent the Section 199A deduction for qualified business income, which effectively makes the top rate for business income 29.6%. That 199A deduction is a 20% deduction from your qualified business income. And then we already talked about the SALT cap for 2025.
I think just one point, like when you talked about the standard deduction increase or whatever, that the nice thing too is if you do have that pass through entity tax, right? It's not hitting to the itemized deduction, and therefore maybe you get that deduction plus you take the higher standard deduction. So again, as you're looking at it and talking with your tax advisors, some of that planning is, it's not big dollars, but it is something, and every little bit, helps.
Correct. Estate and gift tax provisions. Prior to this bill, the estate and gift exemption was set to decrease to about $7 million. This permanently increases that lifetime exemption to $15 million for single filers and $30 million for joint filers. And both of these figures will be indexed for inflation annually. It does the same thing for generation skipping transfer tax exemptions. So those things will now are going to remain aligned. And then the top estate gift and GST tax rate remains 40%. That was set to increase back to 55% if this bill was not passed.
The only additional thing that I say here too, and talked about on a previous webinar, is just that what this does is just makes you want to think about succession planning in general. And a lot of times with our system integrators, there's been a lot of M&A activities over the last 3 or 4 years. I know it's slowed down, and not everyone is doing as well this year just because of the economy and uncertainty of everything. Could be a great time to think about gifting as well, where you're down the road, you think you're going to grow your company to 50 plus million in revenue. It's going to sell, you got an EBITDA of 15%. It's going to sell for 8 to 10 times. You might be over that $30 million threshold. And if you look at the gifting opportunities right now, you may be way under that. Get it out of your estate and be able to save money long term. And it's something a lot of times business owners don't look at until, oh my God, my number is way more than I thought it was ever going to be. And so it's one of those things again that I think is very important to talk about.
Yeah, and Tim makes a great point. So in years where you're having some down years, that's the great time to have a valuation for gifting purposes, because you want to gift at a low level and sell at a high level. And so to the extent that you have an opportunity to potentially gift ownership in a business at a lower level, I would highly look at potentially doing that. A couple of other individual provisions which probably won't apply to too many people on this call, but may apply to family members of yours. Auto loan interest on domestically assembled vehicles is now deductible up to $10,000. It phases out for modified adjusted gross income above $100,000 for single filers and $200,000 for married filing joint. This is a deduction that is allowable for folks who do not itemize on their tax return. So you would still be available. This deduction would still be available even if you're taking the standard deduction. So I think that that's important. There's an itemized charitable deduction floor now, which is it's limited to contributions above 0.5% of adjusted gross income. Non-itemizers can deduct $1,000 or $2,000 for joint filers. And then there's a concept called Trump accounts. These are expected to be available sometime before July 4th, 2026. They have 12 months to come out with guidance and rules and allow financial institutions to roll these out. It's limited to $5,000 in annual contributions. It will be funded with $1,000 automatically from the government for children born from January 1st, 2025 to December 31st, 2028. Earnings in these accounts are tax deferred until withdrawn. They sort of going to act like an IRA account. I think there's some question as to what the real benefit is, especially if you're opening up an account for a child who is born prior to January 1st, 2025. But certainly talk to your financial advisors about whether or not an account like this makes sense for you. There's some energy incentive changes that could be impactful. It terminates the Section 179 deduction for property unless construction begins before June 30th, 2026. It terminates the charging station tax credit for property placed in service after June 30th, 2026. And it starts to phase out the solar investment tax credits for commercial buildings. So if these are things that you were thinking about investing in, think about doing, pulling those investments forward before these phase outs start happening, or make sure you understand what the impact of the loss of some of these incentives may be to you.
Really quick, just the section 179 cap D, what's the difference between that and regular 179?
Tim, I'll let you handle that one.
Okay. It just the cap D is just kind of your energy efficient lighting, HVAC, different things. But there is within the SI industry, there's a lot of you guys that do some electrical work or different things like that, and maybe doing that for nonprofits. And there's the ability when it's your own building to get $6 square foot on work that you're doing, and effectively, if you're doing it for a nonprofit, you can get allocated that $6 a square foot, right? So if you had $100,000 building that you did some work for, and you get this full $6, you could get $600,000 deduction. That is a permanent difference that you had no deduction because that you were the first one to get allocated that right to get it. So it's something to kind of look at if you're doing some different HVAC, lighting, different things for nonprofits out there. But it's got to happen or occur before June 30th, 2026.
Yeah, I would say nonprofits, governmental. So, if you're in the like wastewater business or something of that nature, doing HVACs for hospitals or schools, these are potentially incentives that may be available to you. So certainly something to think about. A few other provisions. I'm going to touch on the international provisions. I'm not going to go into too much detail, but there have been some changes made to the international provisions, which were enacted with the Tax Cuts and Jobs Act, and most of them are not favorable. There was a concept called GILTI, which was enacted with the Tax Cuts and Jobs Act. They've renamed this concept to net CFC tested income. And the reason why they did that is the GILTI calculation allowed for a 10% return on tangible property. The new provisions no longer allow for that return, therefore broadening the tax base of income that will be subject to this provision. In addition, the old provisions allowed for a Section 250 deduction up to 50% of the income that you were recognizing. That was set to sort of phase down to increase the GILTI tax rate. The new rules have made the new deduction at 40%, but that level is set permanently. So the effective rate for GILTI for 2025 was going to be 10.25%. It's going to increase to 12.6%, but at least now that 12.6% effective rate is permanent, meaning the deduction is permanent and the calculation as is permanent. That is the effective tax rate before foreign tax credits. You are allowed to take foreign tax credits against this income. And the old GILTI had a haircut on the foreign tax credits allowed of 20%. The new provisions have reduced that haircut to 10%. So potentially, to the extent you have foreign taxes being paid in a jurisdiction that's generating this GILTI income, maybe your GILTI tax liability will actually go down. Similarly, there was a concept called FDII. It was foreign derived intangible income. They've renamed this FDDEI, and the deduction is now set permanently at 33.34%, resulting in basically an effective tax rate on income derived from basically export activity to 14%. Both of these concepts, though, are only applicable. Well, FDII is only applicable in the C Corp environment. So if you're an S Corp that has international activity, you're exporting goods or services, you will not get the benefit of this deduction. Similarly, the GILTI deduction, the 40% deduction I talked about, is only available for C Corps. If you're an S Corp that has a controlled foreign corporation, and you're recognizing GILTI income, you do not get the benefit of that deduction without certain elections being made that are fairly complicated. And then lastly, Tax Cuts and Jobs Act implemented this regime called BEAT, which is a base erosion tax. and that rate was 10.5%. That rate has now been set permanently at 12.5%. BEAT is only applicable to companies that are over, this number is indexed for inflation, and I don't know the amount off the top of my head today, but around $500 million in gross revenue. So a lot of companies are not subject to this BEAT regime. But if you're at that level and are subject to BEAT, just know that that tax rate is going up.
Did you want to touch base on the excess business losses at all?
Oh, sorry. Yep. So excess business losses is another concept that was created with Tax Cuts and Jobs Act. And basically, it limits the amount of business losses that are allowed to offset other income running through your return to $500,000 for joint filers. It's $250,000 if you're a single filer. That provision was set to expire with many of the other provisions at the end of this year. This new bill makes that permanent, and it modifies the limitation on excess business losses slightly, but in concept, it remains the same. So just know if you have losses that are running through, you will continue to be limited on how much you can take to offset other income that may be running through your return. That includes items like wages, interest, dividend, capital gains.
Going back to that, I know there was a lot of talk in the bill on this one, being able to only offset against the company's income. That did not make it into the bill, is that right? Meaning like you have other income from other sources outside of the operations that loses money. You can offset that.
I might not have followed
Two,
the
if you
question.
have two, the question really was if you have two sources of income, one has a loss and one has income, you can offset the income against that loss. There was talk in the bill, wasn't there, that that income, that loss would only be able to be offset once you had income.
Correct. Yeah, that didn't make it into the bill.
But the 500,000 the following year, if you had $2 million of losses, the first year you can only use 500,000. The next year you could use the remaining amount.
So, so to the extent that you have excess business losses, it becomes an NOL, a net operating loss carry forward. And then that net operating loss carry forward is limited to 80% of total income. So, yes, but there is still a limitation there. Few things that didn't make the bill. There was talk of a 15% C Corp rate for manufacturers. That did not make the bill. They talked about increasing the qualified business income deduction from 20% to 23%. That also did not make the bill. And then they talked about some increased revenue thresholds for favorable accounting methods, which would have been fantastic, but those also didn't make the bill. There was talk of increasing the thresholds from 31 million to be on a cash basis, from 31 million to I think it was 70 million. So that would have been a pretty big, a huge deal for a lot of companies, but unfortunately, those items didn't make it into the final bill.
Yeah, and I was talking to one of our other tax colleagues yesterday, and he's thinking that I can't remember which senator, but one of the senators was saying that there may be another tax reconciliation bill coming down the pipe, and these couple of these items are items that they want to potentially move.
Yeah, I think Senator Thune wants these to be in the bill, but um, we'll see what they're able to do. I think the big theme here is timing is of the essence, especially for planned capital equipment investments that surround energy efficient property. Also making sure you're working with your payroll provider for overtime reporting. I presume most folks on this call aren't reporting tips, but making sure that you're well prepared in advance of January to report these things on the W-2s, I think will be important. Wait for guidance on how the R&D, the 174 amendments are going to be, what guidance we'll get for that. Update estate planning factory construction planning. And then I didn't touch on this, but there's also some changes to opportunity zone funds and investments. The guidance on that will be forthcoming. The guidance on this area has been coming out. I mean, since Tax Cuts and Jobs Act was enacted, we're 8 years and we're still getting guidance on that. And so I think the guidance on the opportunity zones may be a little bit slow to come. Our recommendations: stay current on the application of tax regulations. Make sure you're talking to your advisors. Forecast financial implications of tax policies on your business and monitor how they impact your business. We're here to help. We're doing this for our clients consistently, and we're getting in front of them to talk to them and model out how we think some things may impact them, especially for 2025 and quarterly estimates. So hopefully your advisors are doing the same.
So we'll open it up to questions. If anyone has any more questions, please put them in the chat. But before we get to those, I had one other question that came up is, during when the R&D had to be capitalized, there was, some people decided that they didn't want to capitalize the stuff, so they weren't taking the R&D credit. Now moving forward with it getting back, what would you say to somebody that thinks that they may have had R&D in the past, but know for sure that they haven't now? What would your suggestion be?
I would suggest that with the sort of revised allowance of expensing, maybe now is not the time you be conservative. I say that with a little bit of hesitation, only because you don't want to take a position on your return that is vastly different to positions that you've been taking. You don't want to sort of raise a red flag somewhere, especially if you're over that $31 million threshold where you don't have the allowance to go back and amend. But I would certainly take a harder look at what I'm qualifying and maybe revisit whether or not I have more qualified activity to the extent that you really scaled back on it. I think I'd be talking pretty hard with my R&D tax credit provider, or if I'm doing it internally, probably talking a little bit more with my engineers about what could be qualified.
Okay. I'm really not seeing any more questions. I know we've asked most of them. So I think with that, I think we're all set, Lisa.
Sounds good. Thank you, Mike. Go ahead, Sarah.
Oh, I was just going to say thank you for everybody's time today.
We appreciate it, and hopefully you guys got stuff out of what we had to say.
Awesome. All right. Well, on behalf of CSA, I would like to thank our speakers, Tim and Sarah, for this informative discussion, and also thank WIPFLI for presenting this event. And of course, thank you for attending. Be sure to bookmark the CSIA events calendar so you don't miss any upcoming events. And that's a wrap. Thank you for joining us and have a great day.